presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone, and welcome to the Compak Asset Management YouTube update for October the 1st, 2021. I'm Moe Ansari, President of Compak Asset Management and host of Market Wrap. We have a number of events scheduled. I will be in Scottsdale next week on October the 6th, where I will do a seminar, live seminar, where I will do it. I will be there in person. Seating is limited because of COVID. We have to do social distancing, so we are very limited there. But if you'd like to attend, we still have a couple of seats available. You can call right now, pound 250 on the cell phone, and say talk to Moe, or just go to compak.com and you can reserve your free seat. Then I will do the Zoom webinar that will be available worldwide that I will do on October the 13th. This is going to be hundreds upon hundreds of you are going to be in it. It's going to be our biggest webinar of the year. Sort of looking at where we are now, where we're headed for the rest of the quarter, for the rest of the year, and then looking at 2022. I will go into in-depth analysis of the economy, U.S. economy, the global economy, look at where interest rates are headed, the impact of interest rates. By that time, we should know what happens to the infrastructure plan and the social infrastructure, the Build Back Better plan, what happens to it if it passes or not passes, and where we stand on that. October 14th is Denver. If you'd like to attend, we'll do a webinar there, a seminar there. If you'd like to attend, you can obviously go to compak.com. And then October 16th, I'm in Los Angeles, where I will do a seminar. So these are all the dates. If you would like to attend any of these events, you have to go to compak.com and register right now. But next week is Scottsdale. I will be there on the 5th and the 6th. The 5th, I will meet with individual prospects, people who want to see our program, who want to set up a roadmap to get from where we are now to where you want to go financially. If the last couple of weeks have really have given you a reality check that this is the volatility that we are going to see, and I think this is just the beginning of the volatility. We've got a lot more to come as interest rates go up, and I'll talk about that. So make sure you circle those events, those dates on your calendar. Looking at the numbers, the recovery tracker, how are we coming out of the recession? We're looking at initial jobless claims. They're still elevated, but from the 2019 level, but they have come back down quite a bit. Continuing claims, they are still elevated quite a bit, but we are coming back. We're about 68-70% of where we were. Weekly retail sales, you can see this was the level in 2019. This is the level now. We are moving up. There's a lot of money that has been saved or has not been spent. We just didn't have the opportunity. And that pent-up demand, as I talked about earlier on this year, we're going to see people roaring back, catching up on their vacations, on their travel. They did that, and then I said, well, September, we get back to school. People sort of try to get back to some kind of normal routine. Obviously, 3-4 months ago, 5 months ago, I did not know about Delta. That has slowed things down a little bit. But I think we are getting finally past COVID. We are getting to that herd immunity. We're getting those vaccination numbers and the infection numbers up, where we have immunity between vaccination and people who were infected, getting to a place where we are getting to the 80-85%, where we are going to see a decline in the number of infections and hospitalizations and consequently fatalities. Looking at weekly sales, box office receipts, still not going to the theater. I think we've all gotten so used to Netflix and Prime Video and all of that, watching television at home, that's going to, I think, change for a long time to come. Rail traffic, we're seeing it's just slightly lower than where it was in 2019. I think that is due to the supply chain issues. We're having a lot of problems at the ports. We're having a lot of problems with unloading all the containers from the ships that are lined up here in the port of Los Angeles and Long Beach. You can see, look out the window. If you look out on the ocean here, you can see tankers, cargo ships just lined up waiting to unload. And it is due to shortage of rail, shortage of trucking, and that is just so much product is sitting out there that is waiting to come in. Steel production, we're higher than where we were in 2019. Hotel occupancy, well, we're just slightly lower, about 10% lower than where we were. Restaurants, we're getting back to where we were. TSA, we're still not traveling as much. And Delta, I think, slowed that travel down a little bit, especially the business travel. People are still saying, well, if we don't have to travel, let's just stay where we are and let's do a Zoom meeting. Automobile, we're driving in, again more than we were in 2019, but global flights still, I think we're opening up now. In November, we are going to open up pretty soon travel from Europe for vaccinated people who are vaccinated. And I think that's going to be the case. In Los Angeles, they announced that every school child has to be vaccinated over 12 to go to school. That's just a mandate that has been put out here in California. And I think that is going to become a national mandate sooner or later, just like we have for polio and measles and smallpox and all of these other diseases that we have literally eradicated from our nation. I think we are going to get there with COVID also. Again, concern about COVID-19 among vaccinated and unvaccinated individuals. Unvaccinated, concerned about COVID, 44% people vaccinated and getting breakthrough cases, about 58% of people are worried about that. But if you look at this map, this shows if the number is below 1, it shows that it is not expanding. That's the virus is not spreading. There's only about 3 states, a couple here and Alaska, that is still spreading. The rest of the states you can see we are in where the virus is starting to decrease. As I mentioned a month ago or so that I thought it would follow, Delta would follow what happened in the UK, saw a spike, and then we started to come back down, and that's what we're seeing here in the United States also. We started today, the market, after a bumpy quarter and a really bumpy month. September is usually a bad month for the market. We see some wobbliness, some shakiness, some seasonal tendencies all kick in, and we did. The markets did back off a little bit in September, but we started October with a bang. We're up nicely today, but I think we've got more volatility to come. This is the pattern, historical seasonality that we've seen September through December. September 1st, we go sideways. End of last couple of weeks of September, we come down, usually make a bottom, start coming back up as we go into October. Make a bottom, bounce, come back up and down into the first week. That's where we are. I think we could get a little bit more decline, and then we start moving up, come back down at the end of October, and then we start the Santa Claus or the Christmas rally. I think that's the pattern we are going to follow. We are going to get some hesitancy going into November because of the taper announcement that probably is going to be done in November. Tapering is where the Federal Reserve starts putting less money, decides they're putting in $120 billion or buying bonds at the rate of $120 billion per month. They're going to announce that they're going to cut that back, and that is called tapering, where they're going to gradually decrease the amount of money or the amount of bonds that they're buying. This is what Jerome Powell said. I'm going to get into a lot more detail on these at the webinar on October 13th, but this is what Jerome Powell said. The economy has made progress towards these goals. The progress continues. Broadly as expected, the committee judges that a moderation in the pace of asset purchases may soon be warranted, and that's exactly, he has gotten the market ready. As we go into taper, historically, we've seen the market get a little bit shaky. After the Fed cuts back on the bond buying program, that's when we see things pick up. But there are a number of cross currents out there right now. We've got the Chinese, which save 70% of their money to put it in real estate. They don't invest it in the Chinese stock market. They put it into real estate. That's where their savings go. In an Evergrande, which is one of the largest real estate companies about to go broke, they've got 1.4 million units that they've taken deposits on that they are not going to build. What is going to happen to all those deposits and all those people that invested in all that property? Will that contagion spread throughout the Chinese economy if the property market starts to come down in China? And what kind of impact that'll have on the Chinese economy and the knock-on effect on the global economy? That is yet to be determined. I remember Bernanke in 2007 saying, raising interest rates, he was the chairman of the Fed, and said, the housing market is not going to bleed through to the economy. Well, when the housing market crashed here in 2009 and 10, you saw what happened to our economy. We had one of the worst recessions since the Depression. So that is an unknown out there. Will the Chinese? I think the Chinese, with Xi Jinping wanting himself to be nominated for life or at least for another 4 years, that party meeting coming up next year, he does not want to have the public get very upset with them. And if they start losing money in real estate, they will get upset. So I think the Chinese will come in and put in some money and try to bail out some of these real estate companies. The Biden agenda, and that's the volatility we've seen over the last couple of weeks. Will they or won't they? Will the Democrats get together? The liberal wing and the moderate wing is fighting amongst themselves. I think this is critical for the Democrats if they want to hold on to power. If they cannot get the infrastructure bill, which was passed with the Republican support, it's a bipartisan bill that everybody knows, that even the Democrats themselves know, that we need to build our roads, build our bridges, build our airports, build our water systems, build our internet to compete globally. That is about a $1.2 trillion bill that has already passed the Senate, sitting in the House. But the House is fighting. The liberals are saying, no, we're not going to pass this bill unless you give us another $3.5 trillion for social infrastructure spending and tax increases. The moderates are saying, let's pass this bill and let's get work on the other one. Manchin and Sinema have said they'll go to $1.5 trillion. Probably, as I said a couple of months ago, we're going to get a couple of $1 trillion in social infrastructure spend. They will come together sooner or later, as they always do in Washington. The Democrats' survival depends on it. If they're unable to get this done, I think they'll have a very difficult time in 2022. They might end up losing the House and the Senate both. That could be a problem, and that obviously will basically hamstring the president for the rest of his term. And then again, we've got elections in 2024. But this is something that the Democrats, they campaigned on. This is what they want to do. Will they be able to do it? The $3.5 trillion is basically a tax bill, the way I look at it. If we pare it back, less taxes, which is good. If it's more, it's bigger, there's more taxation. Taxation always slows the economy. As I've pointed out, and I'm going to get into a lot more detail into this, what taxes could be going up, how those taxes are going to impact economically. I don't want to get into the politics of this, but how is it going to impact the economy and consequently the stock market? I will talk about that once we have something done on the $3.5 trillion. The bill that is coming out of the committees is 2,700 pages. So there's a lot of stuff in there. What gets through, what gets passed, who knows yet. We will see exactly what comes out of it. Looking at the technicals of the market, we have made a fifth wave top on the daily charts. We've started a wave count to the downside. This was wave 1, saw a bounce wave 2, gap below the 50-day right here, and then we accelerated down, came down to the 100-day. Now we bounced off the 100-day, which is a 43.18. Last night, this morning early, we got as low as 42.88. That is very close, not quite there, to the 42.33 low that we made in July, but we have, I think this is wave 1, wave 2. Now we're going to see a fourth wave rally, and then we can come back down. I think that's, if we do get the bill agreed, President Biden has gone to the House trying to get the moderates and the Democrats and the liberals together and figure out exactly how they're going to pass the bill. If they do pass the 1.1 trillion this weekend, I think it'll give us a rally. If they do not agree, then and hold the 1.1 trillion hostage to the $3.5 trillion bill, then I think we are going to see a lot more delays and there could be another decline. Looking at the short-term chart, this is where each bar is 60 minutes of trading. That's what this is. So each one of these green and red lines, that vertical lines that you see, is 60 minutes of trading. We made a fifth wave top right here, 1, 2. This is the third wave decline. We came down 42.88 this morning, and then we rallied back up. This is wave 4, which could take us somewhere up to, we made a high today of 43.64, closed at 43.57, close to the highs of the day. So I think we can come back down. 43.75 was the high today. So I believe we are going to come back down at least one more time. We have a chance of coming down to this low, making even a lower low, somewhere around 4,200 or 4,250 or so. If we do, I think that's going to be it. If we break below these lows, we don't get, then we go all the way down. We have to start looking at weekly charts. Weekly charts seems like we've made the third wave top. We're starting, is this going to be a fourth wave pullback, or is it going to be something smaller like this, what we saw earlier on this year? If we do get this is going to be the fourth wave pullback, then we could come down all the way down to 4160, which is somewhere 4137 is the 200-day moving average, which could give us that 7, 8, 9% correction in the S&P. So we're not quite out of the woods yet, but I think, again, as I said a month ago, if we do get pullbacks in September, you need to have your list ready to know what to buy and be able to move your portfolio. I think we are going into the reopening trade, which is the small caps, and that's what I'm looking at more than anything else. Nasdaq looks a little bit weaker, looks like it's going to get down to that 14,000 level, which would be a test of the 200-day moving average, down about 1,500 points off the highs, and that would, I think, suffice for the pullback in the Nasdaq. I think we've had a great run in the last year and a half or so in the large cap technology. As interest rates go up, which I anticipate they will, and I'll show you a chart of the yield of the 10-year, as that continues to go up, it's going to continue to slow down large cap technology. But the beneficiary on the other side, they'll only raise rates, and rates will only go up if the economy is doing well. And that will give us some chance to look at the small caps. And I'll take a look at that chart. This is a weekly chart where each one bar is 1 week of trading. You can see that we're sitting at the 20-week moving average right here at 15,570. We closed today at 15,566. So right there is where we closed. If we break there, then we can go down to the 50-week moving average, which is 13,639. I think 14,000 also is going to give us quite a bit of support. One of the things that we do see, you see these dots right here, when they're below the market is uptrending. When they get above the market, usually it gives us a little bit of a correction. We saw that last year, and this week we broke. The dots have moved to, the dot plot for me has moved to the upside. That gives me a downward trend again in the Nasdaq. So that Nasdaq has to lead the market to the upside, or at least the small caps do, which is the reopening trade, as I call it. And that's what I'm looking at. Looking at gold, very disappointing. It got to the 200-day, but we've started a wave count to the downside, wave 1, wave 2, wave 3, and this could be wave 4. This is critical support at 1675. We've been there 3 times this year. If we break below 1675, I think we could accelerate down in the gold market. As interest rates go up, the dollar goes up, which is negative. As far as rates are concerned, I think, will continue to look to the upside. The Russell is setting up what is called a triangle, where you take these lines, connect the highs, and that gives us a resistance area, and then you connect the lows, and it keeps getting tighter and tighter. We usually break out one way or the other, to the upside or to the downside in these, and whichever way we go, usually it's a big move. We've been stuck in this range between 2360 and about 2100 for the last year, since the beginning of the year. So it's been a very long consolidation. The bigger the move, bigger the base, the bigger the move, as we say in technical analysis. If we can break out above 2360, that'll, to me, clear that small cap. That's usually smaller companies that are more locally based, and those companies are benefiting when we reopen. Once we get above 2360, from the market perspective, it'll show that we are finally starting to put COVID behind us. We're starting to get out. The small businesses are starting to do well. That, to me, would be an indication. So I'm watching this. The first number that I'm looking at is this line right here. If you break above it, that would be the first indication, and then 2360. That's the next one that I'm looking at. The Treasury Yield has gotten above the 200-day. Yields go up, bonds go down. You can see that today the yields were down quite a bit, but the resistance is right about here at 1.6, then a little bit at 1.7. But the target for me is about 1.85. That's the target up here, and that would be, we're at 1.46 or 1.5 today on the interest rates. If interest rates continue to rise, which I anticipate they will, that'll create some more anxiety in the market. I think the market will get over it. 1.5 to 1.8 doesn't really make that big of a difference, but it will take some, it'll give some more anxiety to the market. So I think a lot more volatility. Make sure you have the right allocation in your portfolios. I think a lot of people who got unbalanced in their portfolio got a reality check over the last couple of weeks. Market went down 4 or 5%, they lose 15, 20%, and they're done. You don't want to have that kind of exposure in your portfolio. You want to have the right risk number. You want to have the portfolio to match that risk number. How do you determine that risk number? I'll show you at the next webinar or the next seminar, so make your reservations for those. Looking again for the next week, I'm in Scottsdale. Then there's a Zoom, that's a global Zoom webinar that I do on a quarterly basis, and we already have hundreds of you already signed up. But go ahead and sign up at compak.com and make sure you do that Zoom webinar on the 13th. On the 14th, I'm in Denver. On the 16th, I'm back in Los Angeles. So I'm back. I'm traveling. It's wonderful to see all of you. Put some faces behind all the voices, all the people that I talk to. And again, register today. And don't forget to subscribe you can go and get the daily 1 hour broadcast that I do nationally. It's a podcast also. You can download it from the App Store. Just type in Market Wrap with Mo, and that will give you the link to it. You can find it there. It's a free app, and you will get the 1 hour broadcast that I do every day. And don't forget to subscribe to this YouTube update, so whenever I post an update, you will be notified. Thank you again for tuning in. I'm Moe Ansari. I will be back with you. Look forward to seeing a lot of you at the webinars and the seminars.
This presentation contains the current views and opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.